Hi everyone, welcome to the Value Investor YouTube channel. Let's see our journey to find a new book, because our initial book, The Warren Buffett Way, has already taken by another group. Check it out! Hi everyone, finally we find a book, The Intelligent Investor by Benjamin Graham. Now it's time to review the book. A successful investor doesn't require stratospheric IQ, insider information, or luck for that matter. Instead, what is needed is a strong intellectual framework for making decisions, combined with the ability to keep the emotion from damaging it. The most successful investors were not made in a day. It takes time, and we have to learn about financial foundation and investing method from various sources. One of the best ways is by reading a book. In The Intelligent Investor, Benjamin Graham presents such a comprehensive framework that easily understand for beginners. Even Warren Buffett, the most successful investor of 20th century, referred this book as by far the best books on investing ever written. In this video, we will cover the Intelligent Investor book review along with the great takeaway of the best concept covered by Benjamin Graham. Now, we will share the greatest takeaways from this book, and there are gonna be 6 learning points from the book. Number 1, what is the difference of investing versus speculating? Number 2, have you ever affected by Mr. Market unstable reactions? Number 3, how to invest as a defensive investor. Number 4, how to invest as an enterprising investor. Number 5, what is the importance of margin of safety? Number 6, how to utilize fundamental analysis as a vital aspect. Now, let's discuss from learning number 1. I will give it to Liany.
Hi guys! Today we want to book review of The Intelligent Investor. Okay, learning number 1 is investing versus speculating. Benjamin Graham said that an investment operation is one which undergoes through analysis, promises safety of the principal and satisfactory return. Operation not meeting this requirement are speculative. Let's understand this concept with the help of example. Imagine you are planning to buy a printing press. Now, to buy this company, you can use these 2 approaches. First, you visit the company, calculate the asset of the printing shop, check the total income and cash flow of the company, verify the effectiveness of the managers, calculate the total asset and liabilities, and lastly come out with the final price of printing company. Full fundamental analysis applied. And the second approach is that you meet this owner and decide to pay the price, and whatever he is asking for just by guess, and foreseeing the value company without any data on hand. For this example, we can establish the difference between an investor and speculator. First, the investor. If you are the investor is going to invest company, you will believe that will generate profit through their ongoing business operation. Second, investor acquire and hold security that they believe will grow in value over time as the business succeeds. The third, That means intelligent investors look at the dividends and business growth as the source of their gain. Investor trade are goes through proper fundamental analysis, consider all the current aspects to the foresee future, and the gets adequate returns from the investment. If you are the speculator, you will be the someone who acquires shares at what they consider to be a favorable price and then sell off as soon as possible for a profit. Speculators always believe the odds are in their favor even when they do something outside normal investment practice. Speculator trades are evaluating the company without data on hand, guess the feature, emotion was the involved throughout the decision process. And the last one, the recommendation is being an investor is always do everything possible to increase their chances of success by calculating their margin of safety by figures, reasoning, and by reference to a factual data. Okay guys, that's the chapter number 1. We already learning about the investing and speculating. Now we will learn about the chapter 2. My friend Meili will explain you more about the chapter 2. Meili, it's your turn now.
The Intelligent Investor by Benjamin Graham. Thanks Liany for sending me this great book. What we can learn from the chapter 2 of this book is be aware of Mr. Market. In the book Intelligent Investor, Graham tells a story about a man called Mr. Market. It is imaginary character created by Graham as an allegory for the emotional swing that the stock market takes and the grouping that happens in the stock market and the investor. In the story, Mr. Market is a business partner of your investor, and it illustrates the danger of getting caught up in the market sentiment that causes share prices to rise and fall on investor emotion, can be driven by panic, euphoria, apathy, rather than the fundamental analysis. Daily fluctuating share prices can be ignored because, in reality, the underlying value of a company doesn't vary dramatically from day to day. So, what's the recommendation? Graham advises against reacting immediately to swings in the market or swing in Mr. Market mode. Recommendation number 1. Base your buy and sell on your own analysis of the company business prospect rather than the short-term movement in the share price. Number 2, when you have done the fundamental analysis and invested accordingly, you will have the confidence that your own reasoning is valid, which enable you to stick to your plan. Number 3, an intelligent investor will attempt to take advantage of Mr. Market by buying low or selling high. Number 4, as an intelligent investor, you are doing business with him only when it is to your advantage. That's all. Graham emphasizes the virtues of simple portfolio of value companies, and his overall message for the intelligent investor is real money is not made by buying and selling or timing the market, but by owning and holding securities and receiving dividends that grow in value over time. There are many more lessons learned that we can get from them. Now, it's your turn, Maria, to tell more about this book. Maria.
Okay, learning number 3, how to invest as a defensive investor. For nowadays, busy people make investment as side activity. Defensive method could be the best option for them. Defensive investors should create a portfolio with a mixture of bonds and stock 50-50. Remember, 50-50. This is how much you should devote to each asset category depends on your situation and current difference in the average yield of stocks versus bonds. Restart this allocation once or twice every year so that it sticks to that ratio. Invest a fixed amount of capital at regular intervals. Then it will assure that you don't concentrate your buying at the wrong time. For the stock component of the portfolio, the defensive investor should aim for the following rule. There's 8 rules to remember. Number 1. Diversify company. In range 10 to 30 should be enough. Also, make sure not to overexpose to similar industry. Number 2. Large company. More than a $700 million in yearly sales should be great. Number 3. Financially stable, with current ratio more than 200%. Number 4. Dividend should have been paid to shareholder for at least the last 20 years. Number 5. No earning deficit absolutely in the last 10 years. Number 6. Earning growth, at least CAGR more than 2.9% for 10 years. Number 7. Cheap assets. The price of the stock should not be higher than 1.5 times its net asset value. Number 8. Cheap earnings with PE ratio below 15 when using last 12 months data. Our recommendation is it's better for defensive investor to put investment in a stable, high revenue company and divide your choice in a different sector company. The goal is to get the average return as market. So, you should read this book.
Learning number 4. How to invest as an enterprise investor. To be an enterprise investor and gain more profit, it requires patience, discipline, and eagerness to learn, and a lot of time reading news and analyze data. Price is truly an important factor for the enterprising investor. Just like the market tends to overvalue company when they have been growing fast, it tends to undervalue the ones with unsatisfactory development. The intelligent investor should avoid growth stocks as much as possible. Why? Simply because the investment decision is based relatively more on the future earnings, and future earnings are less reliable than current valuation. If you can find a company is valued lower than its net working capital, you essentially pay nothing for all the fixed assets, such as buildings, machinery, goodwill, etc. The net working capital equal with to current assets minus total liability. For the stock component of the portfolio, the enterprise investor should aim for the following rule. The first one, diversity. The second one, small large company. The third one, financial stability. Number 4, dividend. 5th, no earning deficit. 6, earning growth. 7, cheap asset. And the last one, cheap earning. The recommendation is, in analyzing a company, the enterprise investor should always study its annual financial reports, so the decision will be more valid by foreseeing future earnings rather than see current valuation.
What is the importance of margin of safety? Margin of safety is one tool to minimize risk in every investment you make. Price and value of company is not always the same. For example, if a company price is 2 out of 3 times value, then the investor has found a company with enough margin of safety. Margin of safety is the central concept of the value investing. If you think a stock value is 100 per share, you should buy at 70, 80, or 90 instead 100. Here, the difference in the calculated amount and your final price is your margin of safety. A formula used in this book can give you some heads up regarding what the value of company is, and therefore also if it can be bought with a margin of safety. And the formula is value equals current earnings times 8.5 plus 2 times expected annual growth rate for 10 years. The conclusion: Graham's principles deals directly with the investor need to both understand and minimize inherent risks. This margin of safety concept further differentiates investing from speculating.
Learning number 6. How to utilize fundamental analysis as vital aspect. To succeed as an intelligent investor, you must learn how to value company on the basis of sound financial analysis. The basic fundamental analysis meaning is a method that is used for measure the intrinsic value of a stock or security. It mainly depends on the economic factor affecting the business and its financial. This process is not only limited to the company financial structure, but it goes beyond that. It includes the general economic scenario, the industry growth and fall, along with the company organizational structure, management, and financial. For fundamental analysis strategy, there are few fundamental analysis basics which need to be considered. These are primary factors which affect the analysis of stock, and they are company revenue and its structure, growth of the revenue over the years, profit made by company in the past year, debt structure of the company, rate of turnover, employee management and management approach toward its employee. These are 6 basic factors that are looked at while doing fundamental analysis of any security. What are the objectives of fundamental analysis? The objective of fundamental analysis of stock market are to predict the future price of the share of the company, to do valuation of the asset of the company, in order to project the performance of the business, to measure the credit risk, to evaluate the management decision, in order to find intrinsic value of the asset. And the conclusion, for stock, fundamental analysis use the revenue, earning, future growth, return on equity, profit margin, and the other data to determine a company underlying value and potential for future growth.
Number 1, analyze investment for long term, protect yourself from losses, and don't go for crazy profits.
Number 2, choose investment for their fundamental value, not their popularity.
Number 3, know the business you are investing in. For example, read the market dynamic, issue, and other news affected company performance.
Number 4, know who runs the business. Get to know some key person behind the company wheels to analyze even better.
Number 5, never trust Mr. Market. Market dynamic can be very irrational in the short term and medium term.
Number 6, ensure you follow a strict investment formula and you will do fine. And continue 7, have confidence in your own analysis and observation.
Number 8, you have to make your own investment decision based on doing the analysis. Don't speculate, be smart.